Hello and welcome to a brand new episode of ETMarkets AIF TALK, a show where we discuss the opportunities as well as strategies deployed by the fund managers in the popular space of ultra HNI investing. Well, my name is Shadhajanand, and today we have with us a very special guest, Vignesh Shankar, who is a founder and managing partner at Artha 99. Welcome to the show, Vignesh.
Thanks, Shijit. Pleasure to be here.
Thank you so much for being part of the segment. Now, Vignesh, take us through the fund performance of Artha 99, that is CAT1 AIF.
Okay, so first of all, thanks once again for having me here. This is our second fund that we are running. So the first fund was more of a prop fund, proprietary capital that me and a couple of my friends from school, we put together. That's why that 99, right? So we finished school in 99, so that's why that 99. So The name stuck, Artha as well. So that fund, so we invested in, I'll take you through both the funds actually. The first fund, we made about 4 investments across different segments, including digital yoga, digital transformation, mapping technology, and something in the Shopify ecosystem. Okay, no low code, no code. So in that fund, we have already done one exit. The digital transformation business we invested, we already exited. And the rest, couple of companies have gone ahead and raised their Series A rounds as well. And one company is, a typical startup. It's not shut, but it's still not exactly grown to the extent we anticipate. Okay, so all put together in that fund, if you see, we have, today we are at almost 70% IRR. Okay, because of that one good exit. So we invested in it's a business based out of UK called Futurist. We invested in that business, say in 2020 March, and we exited last December, 22 December. So in 2 years, we almost got a 7x return, thanks to which, it has skewed the IRR in our favor. And the other 3 businesses, 2 of them have raised Series A as well. One from a Silicon Valley fund called Five Elms Capital, and so we are doing well. So that gave us the confidence to raise a larger fund in Fund 2. In Fund 2, we have made 2 investments. One in the electric motor EV space, and the other was in the hyper automation AI platform. So both of them have done very well. So post us investing in the electric motor company, some marquee investors like Ashish Kacholia have also invested in the business. So that's also done reasonably well. Just to put things in perspective, we are getting our NAV revalued as per SEBI regulations now. So we started off at a face value of rupees 1,000. I think from the latest estimates that we see from our valuation experts, it's going to be around 1,200, 1,250. So it's been good in 6 months. We made both these investments in January. So thanks to the pre-Series A strategy, like we have 20%, we are above already.
Right. In fact, you have a very interesting portfolio mix, and I was going through the fact sheet, and India holds a special position in your portfolio now. Why India? Okay,
so good question. So I'll take not too much time, but I think I need to explain this properly. So
no, absolutely.
when we set up this fund 2, we went to SEBI and we got a registration done. The very pertinent questions that they raised. Actually, I should tell you, SEBI is very professional organization, and it asks you very pointed questions on why and what before they give you a license, right? So I believe that people who are doing good with running a SaaS focused fund or AI focused fund, deep tech focused fund, which is great. But I believe India is like a buffet, right? When you go to a buffet, you don't choose to eat only a veg biryani that is kept, or you don't choose to eat only the naan that is there, only the sweets, right? You pick off each of it and eat. So putting that in a very jovial manner. So I don't eat too much in buffets, but so to cut a long story short, right? I think the opportunities are abundant in each of the segments in India, right? So it doesn't really help you with your portfolio diversification as well as your reach across the country if you are sector specific. And also the other side is also, see, for example, India, if you take the SaaS market in India, it will be a $10 billion, $15 billion market, right? It's a big market. But for the $10 billion, $15 billion market, there are almost 400 AIFs almost chasing that segment to invest, which is a good thing, right? So what happens is you have lesser deals to invest in, a lot of investors. So what happens automatically, this is like the share market. So the valuations are driven up. I would say I'll give 10% more, 15% more. So you end up paying prices which are not exactly reasonable for these investments. So Artha 99 as a fund believes in paying the right price. We don't want to, give the short end of the stick to anybody, but we would like to give the right price. So we feel the valuations are driven up. If you take the US is a $100 billion SaaS market. There is enough and more for everybody. So you can be a SaaS focused fund there or AI focused fund there. Whereas in India, we are still on the way up to get there. Right. So if you ask me, largely it's better to be a diversified fund. So that's the strategy. And India is India, man. So I run prior to setting up this fund, I was working for the US MNC as heading the Asia business for a large US MNC. I run business in Korea, South Korea, China, Japan, name it. There is no market like India. You cannot go wrong here. Okay, so when you are in such a market, right, then you better be diversified enough. That's why there are sector agnostic India, and India is our team.
Right. Well, you're right that you cannot go wrong in India. I think that is one we also concur with the same. Now, tell me another thing, Vignesh. What is institutional pre-series and your focus segments which Artha 99 is betting on, looking for opportunities?
Okay, so why did we pick pre-series A as a stage to invest? It's largely if you see the investing ecosystem or the stages in which we invest. Where there's only an ideation, you call it seed stage. Where there's a little bit of ideation has gone to a team and you have started building a base product, you call it angel or friends and family round. And then most of them go to a series A, where the business is a bit getting maturity. There is a bit of a product market fit and traction is there and all. So there are enough series A funds in India. So when we set up this fund, generally the trend that follows in most VC markets across the world is the US leads it. Okay, US is the largest venture capital market today. The trends that sort of arise in the US, let's say in 2010, 2015, come to Indian shores 2018, 2019. So I thought, why do we have to wait for a trend to catch up? Let's see what's happening in the US market already, right? So we saw that this pre-Series A segment was attracting a lot of traction over there. Okay, so we went to understand why there's a pre-Series A at all. Why can't you move from there to Series A? So it's very interesting, right? So when you invest in a pre-Series A, the company is raising money to actually build a bridge to its Series A. That means it needs working capital, it needs oxygen to further push its sales, build products, stuff like that. And since they know a Series A is coming, the promoters or the founders are very flexible in their mindset on how they want to sort of raise money. There's no habit of giving 4 term sheets and saying, these 4 guys are investing. If you want, you also give a term sheet, same values. People are willing to sit across the table and understand as to, what is the valuation? Why are we seeing this as value? Why are we not? It's a very good discussion. We as a fund believe that whether the business is great or not, we should have the kind of sync with promoters. Okay, so that is one check mark for me on pre-Series A. The other thing is, valuation. The other thing is, let's say I invest Jan 1 in a pre-Series A fund. The company has to, for its growth, if it grows according to its plan, has to raise 18 months down the line. Okay. So what happens is my investors, like the people for whom I manage money, tend to see a multiple 18 months from the time they actually invest through us, right? Because you may not move 6 times, 7 times, you'll definitely move 2 times or 2.5 times, depending on how the company has done. So you get a multiple pretty quick, and that helps your IRR, because from Series A, Series B is going to be much higher. Provided the company does, it is all of the disclaimer, the company performs. Okay, right. So this sort of is a good multiple for investors also to come in. And let's say that once you invest, you don't have a great sync with the promoter. You feel that maybe you have misjudged. It happens. Nobody is perfect. You may have misjudged. They may have misjudged. You have an opportunity to exit 18 months into your investment. Right. You are not stuck for the long run. So considering all this, right, I think the pre-Series A stage was a good stage to invest. And also you can play a good role. See, Artha 99 as a fund, we try to work with these teams we invest in, with their sales strategy, with their hiring, with their next round, everything. People are very open at pre-Series A stage, let me tell you, because they want the business to get that steroid boost to go to Series A. So we are happy to do that. So all these reasons, that's why we think this pre-Series A is a very exciting space to invest.
Right. In fact, you've just talked about the the various diversity of businesses that you've invested in. So how do you sort of manage risk in the fund?
Excellent question. See, one way, this may sound a bit contrarian, but one way is we try to identify what we don't know.
Right.
Okay. So I think as an investor, it is good to know a few things, but you should definitely know what you don't know. Okay, so we as a fund, we put up our hand and say, we don't understand this business. But the space and where the potential is very good. So what do? We have assembled a marquee mentor and advisory council. Most of them are investors with us who have spent years and years in different segments. So we have our chairman of the investment committee comes with almost 40-45 years of experience, being part of boards like L&T, Airtel, name it, he has been on their boards.
Okay.
So he gives us some visibility. I have sector-specific experts who sit with us. For example, the past CEO, CFO of McDonald's gives us a retail tech, deep tech investment. We have a couple of scientists who help advise. So when we put up our hand and say we don't know, a lot of people come and tell us, this is the gyan. Then you apply your investor mind to see, okay, these guys are saying this is how it's going. This company is also doing this. Now, what can you do? Then you form a thesis. So first thing that we do to mitigate our risks is what we don't understand. We are very comfortable in saying we don't know this. Okay. Having said that, there are some other, systemic risks that we need to protect us for. So we have an extensive due diligence process. Okay. We do 3 levels. One is, of course, financial diligence. We work with the likes of BDO, Big Four to look at their numbers. We have legal diligence. We have some of the marquee advocates helping us with our legal diligence. But one thing that we still do internally is commercial diligence.
Okay.
Why is commercial diligence always in-house? Because we get to talk to our potential investees, customers, and we tend to understand, how is the sales strategy? First question we ask, what you do not like about it? Tell us that first. And then, so when a potential investing company is happy to connect you and move out of the conversation so that you can understand, that itself is a tick mark for us on how confident is about the business, right? And then we understand from them. Some clients may come back and say, they have not covered this in their product. So it's a good feedback for us as we invest to see how the product evolution should be. So that is one more mitigation strategy that we do. And largely, one thing that we are very, very particular about is integrity and ethics, right? So we run, sometimes if needed, we run a forensics. It may sound very high-handed to say we run a forensics on the investors, but it's not that. Basically, just understanding how is the background, how people are, what is their, their propensity to repay, stuff like this, right? See, they must have the mindset that they have taken my money and someday they have to give me an exit. Can't be that, So we rely a lot on these things and then we put together and judge. So that's how we do largely.
Right. In fact, after risk, we would also like to know, the investment process before you sort of put in a money in a company. It's like, Shark Tank of India, you could say that.
Okay. Okay. So I'm not a big fan of Shark Tank. Having said that, because you cannot invest like that. It's good. It's good stuff to watch. I'm not denying its success, but I'm saying, see, largely we have like sort of a pipeline where or a funnel where deals come. So we are connected across. We have an investment banking network. We have a VC network. We are part of incubator ecosystems. So today, India is the most. You can find an idea generated almost every day in India, right? New generate. So there are enough deals. In fact, the last quarter we saw almost close to 500 deals. Okay, out of which we picked 20. But our process is that we look at what we have in our funnel and we see how the reference. Sometimes references are very good because it gets an extra mileage or extra step for you. Sometimes what appeals to us is the segment. If it's part of our research to say the segment is going to pick up very well and someone is doing some good work there, that is one check mark for us. So we filter it into 10 or 20 deals that we would like to discuss internally. And there are some filters. Like, for example, since we are a pre-Series A fund, largely the companies that come to us should be making some revenue or should be very close to revenue. Okay. I am very comfortable in investing when there is revenue. Okay. That means the company is capable of generating money before it takes my money. Okay. That is very important. And it may not be profitable, but there should be a significant view on when they're going to get profitable or when they're going to break even. So that is something we look for. This is the second filter. Third filter is, of course, what is the underlying? So largely we look at opportunities where there's a digital underlying that the company is building, because the acceleration in the segment in which they are is faster if you have a digital underlying. And then what we also look for is someone else doing this also? Okay. If yes, are these guys doing it better? If no, it's a no-brainer. Nobody is doing this, they are doing it. So we filter these through these kind of deals, and then we have an internal discussion. We have a weekly pitch discussion with all our teammates. We pick 2-3 deals we like, and then we do further. We start talking to a couple of their customers. We start the commercial diligence even before we go term sheet, because we want to know why waste time if your customer's feedback is not good. So we do. And then we put up a note to our IC. So Then we go and I go pitch to the IC. The IC gives me a tough time or a good time depending on the deals I show. And then ultimately we go ahead and give a term sheet. And then the actual diligence process starts. So it's pretty vanilla, but sometimes there are some, let's say we like a deal so much that we feel that we can go ahead directly and give a term sheet, or we can do diligence straight away. We are very quick in those kind of things. So horses for the courses, depending on what we find.
Absolutely. In fact, now we've discussed so much. I would want to also pick your brains on how's the startup community developing in India, and are we looking at companies that will actually become the next large caps? Any segment which has more startups?
See, I'll tell you. I think this again a contrarian view. I think manufacturing in India is set for a lot of disruption.
Okay, right.
And not only because of China plus one strategy, but I think that a lot of entrepreneurs are going to go build boring old businesses which are enabled by tech, but they are still boring businesses at the core. Let's say a specialty chemical business, let's say a industrial manufacturing business disrupted by tech, but in the boring traditional space. And I say boring, it is like long haul, right? I think that is going to be some segment which will definitely disrupt. And of course, you have SaaS. It's like SaaS is multiplying in various ways, can be disrupted. AI, of course, every week you have a new AI concept that is coming in. As a fund, we are sort of a bit distant from AI because we don't know if anyone has timed it correctly or built the perfect AI product.
True.
And we don't want to write too many bets. So we are like that. If you ask me, the ecosystem in India is actually pretty mind-blowing. Not only traditional centers, Bangalore, Gurgaon, Bombay, Chennai are doing well. They are tier 2, tier 3 is really, in fact, a couple of weeks ago I was in Orissa. We are looking at investing in a business there. The kind of infrastructure that the government there and the ecosystem there have set up is phenomenal. Some things we don't have it even in metros. So I think the next wave is going to come from tier 2, tier 3. What I call the Dhoni moment, right? Till MS Dhoni became a player of repute. It was all led by Bombay and Bangalore and Chennai and Kolkata. You didn't have. But once Dhoni came, you see a big list of people, RP Singh, Suresh Raina, everybody. So stuff like that is going to happen in the startup ecosystem where tier 2 and tier 3 are going to generate a lot of potential unicorns and unicorns. So I think the ecosystem is very robust and everybody has a startup plan. I tell you, irrespective of the government or which party they belong to, everybody is focusing on this because they know. Earlier, it used to be giving out loans to PSUs and to companies to generate employment. But they all understand that the employment generation nowadays is going to be entrepreneurial. So they want more entrepreneurs to come and do this. So that's why they are having this kind of... I'm very bullish. I'm sure you can see. So I'm very bullish.
No, absolutely. Absolutely. Well, on that positive note, thank you so much for your time, Vignesh. And that's all for now. But do stay logged on to etmarkets.com for more on news.
Always.
Thank you so much.
Thank you. Thanks a lot.